been a little bit of a differentiation between financial institution taking a risk-based view, but governments and then regulators, and I'm going to say something very controversial, always have that stick that they can use at their discretion, depending on how the situation unfolds. But it's the same thing in the digital world as well, right? Self-declaration and then reasonableness test, I guess, when people are making sure that the documentation matches with the people's IDs and so on and so forth, and you're running background checks to make sure that the people that are in those documentations are not creating, some sort of a regulatory risk for you. So that's what we have seen. How this will play out, I think we're probably about a year away on that, but I think that's a good start. But how the impact of some of the blowups that will happen, which I'm sure they will happen, how that plays out, I guess we have to see.
Just to add quickly to what Stuart said, an important piece of context in relation to the Corporate Transparency Act and the collection of that information in the US. And I'm very conscious and careful of the fact that one of my former colleagues is now leading FinCEN. So I'm going to put on the white gloves here, but suffice to say, in relation to the collection of all that information, FinCEN does not have to validate it, to your point, exactly, right? They're not going to validate that ownership is in fact accurate, right? It's a collection requirement, similar to so many others that regulators have, right? Wherein if there is a potential problem, they have access to that information. And for best practices, right, it is commonly when a regulator looks at the compliance programs, and be it UBO collection, KYC, et cetera, they're looking for effort, right? They're looking for applying that effort. They understand that there is a cost associated with compliance. It is potentially very impactful. So I just wanted to echo the sentiments there.
Thank you, Jesse.
I think we're all very excited about the new FinCEN director. Let's say that.
Wonderful. Okay, I think we can move on to the next team that we found quite interesting. I think that was focusing more on, and I'm sure there are some attendees here that will be very close to their heart, is around ongoing monitoring for crypto assets, PEPs, sanction screening, adverse media. Right, it's nice and well to onboard a customer and do your background checks and validate their ID and background and all that. But how do you, especially in large data sets, right, or a startup, right, which is scaling quickly, how do you tackle that particular issue in terms of just the sheer volume that comes back? We're dealing with false positives, or simple reports, etc. So I'll go to Jesse for at least the crypto angle on that front. Jesse, what do you think? Once you have lots of exchanges that are your clients, or lots of broker dealers that are your clients in that space, how are they addressing this particular challenge?
Well, I mean, in relation to the crypto data itself, one of the inherent values that you have is the provenance and the traceability and the connectivity that you have. So you're not dealing with false positives in the sense of things like transaction monitorings, which is which is really unprecedented. One of the things that attracted me to this space, particularly to Chainalysis, is I come from traditional financial services, and what we know to be true a few years ago prior to when I joined, and to be true today, if we're being honest, is that real-time transaction monitoring in traditional financial services is still not something that really can be applied at scale, right, effectively. What you have in relation to illicit finance is a reactive process where that illicit activity will be executed. Typologies, red flags will be developed, implemented into a program. You try to arrest it going forward. But because of the traceability and connectivity with cryptocurrency, any transfer that has been conducted, right, between these wallets is tracked and is followed. And when illicit activity has occurred, that is flagged and identified as well, meaning that the transaction history associated with any wallet, with any token, lives on in perpetuity. So real-time transaction monitoring does occur, alerts are provided. And not only is that identifying things like direct exposure, but indirect exposure as well. With that being said, however, the regulatory ecosystem is such that it is still developing around the globe. Not all of these exchanges are the same, as you know, and the kinds of entities that are in the virtual asset space. Some of them may be introducing a culture of compliance, others may not, in short, right? And so you do still have issues like regulatory arbitrage and other issues that exist. On the issue of KYC that we just mentioned, some choose to implement robust KYC. Others may not have any KYC at all, depending on the jurisdiction and the kind of operation. So there are some vulnerabilities that exist. There is some real potential in relation to how technology can be applied. It is all digital and it is cross-border, as you mentioned, frictionless payments that can move very quickly. For that reason, these choke points of the exchanges really have to implement global KYC policies and procedures, UBO collection. We are moving in that direction as a result of things like FATF, but it is very important and timely.
Thank you, Jesse. Stuart, so I think this is right down your alley, right? So in terms of the PEPs, the negative news, the ongoing stuff, right? The point that I'm trying to get at is, for example, you onboard company X and then everybody is squeaky clean at the outset. And suddenly there's some transfers of equity or something like that, or associations that come up. And those are questionable or related to PEPs, or people are, in some sort of a UN sanctioned program. In a fast-paced environment, the point that I'm trying to get at is, especially in a fintech space where the scale is achieved quickly and there's a lot of things happening quickly, how can a compliance team address the challenge of a lot of that feedback, right? And how to separate noise from real stuff that they need to look at. So what would be your thoughts there?
Yeah, I think it's a great question, and I think we could do hours on this topic. It's an important one. It is near and dear to my heart. But I think there's a lot of things. There are a lot of things not to do. There are a lot of things not to do that other rapidly growing fintechs have done, like turn off transaction monitoring because you have too many alerts, which was something that I think Revolut ran into in Europe. And I would not be doing those sorts of things, and I would be investing in doing this correctly from the beginning. And when I say doing it, there's an assumption that people are doing it, and I think that assumption that everyone is doing PEP sanctions and adverse media screening to begin with is happening is in and of itself not necessarily true. And so I would say first and foremost, do it. And the reason I say that is there I believe recently, maybe a couple of months ago, an OFAC finding in the US on a crypto related company for not doing sanction screening at all in the United States. And there obviously would be trade-offs between growth, investors pushing you to grow fast, and maybe I'll get around to doing sanction screenings or compliance later. That's just that's a no-go. There's a large payment processor in Europe that we're working with through an intermediary. One of the largest payment processors in Europe has no CIP program. So working cross-border, working globally, could be working with anybody. It's really hard to know who they're working with, who the risk of those entities are. I think that's a problem. And then we're working with a number of entities that just don't do adverse media screening. And so I think that there are reasons why these aren't done. Maybe it's because folks want to grow quickly, maybe because there's a cost element associated with this. But what I would argue is that it is certainly manageable if you sort of start with the right grounding in the beginning, which is to think about what is the business that I'm in, where am I going to be operating, and that sort of goes back to the UBO and KYC discussion earlier, and what is the sort of risk-based approach that I want to put in place with regards to sanctions, with regards to PEPs, and with regards to news. I would say that all three of these aren't created equally, and they apply differently depending on the entity in question and what their risk-based approach really is. A great sort of sub-example of that would be PEPs, and thinking about what level of PEP do you need to be looking at? Do you need to be looking at all domestic PEPs? Do you need to be looking at all level 4 and level 3 PEPs, or is it okay to make the effort, as was said earlier, and look at level 1 and level 2 PEPs and reduce the amount of returns or hits that you might be getting as you scale and grow your organization? You might be able to get away with doing that. And so I would just sort of say being very thoughtful about this from the beginning is important. Once you get going, once your organization starts growing and your client base starts growing, it gets harder and harder to play catch up. And once that's in place, thinking very carefully about your risk-based approach, how you put this in place, and how you work with your technology provider and your data vendor to help you tune this in the way that will work best for your organization. It is all ultimately tunable, and the purpose of all of this is, again, to make the effort to try to identify those risks that need to be reported to law enforcement, and to be set up properly to do that, and be working internally to do that, and working externally with experts to ensure that you have this in place in the right way. The only other thing I'll say, and then I'll stop, is as Jehanzeb mentioned, the ongoing piece of this. So a company or an individual that you work with might be fine at the point of onboarding, but it's really that ongoing piece that's really critical. And I personally worked with an institution in the GCC when I was with EY on a look back that hadn't looked at their customer base and done a refresh of any kind for a decade. And I would argue that a decade is a long time. The Manhattan Project took 4 years. So we need to be looking at stuff more than every 10 years. And ideally, leveraging technology very cost effectively, you can look at this daily, and you should be.
Yeah. So Stuart, you made me think of one, sorry to jump in. You made me think of the conversations and the debates we were having 5 years ago, maybe 10, which was, you bolt on cybersecurity later, right? It was like, oh, now we have to really think about.
Yeah, now we bring that in. Yeah.
And of course, now, a CTO would be fired if it wasn't part of how you actually set up your core infrastructure. And probably the same is true. I'm seeing that trend happen for data science. You can't add data science later. You have to bring it in at the beginning and have the right setup. Otherwise, both those things will just blow up your tech cost. I think, there's a real opportunity for AML KYC professionals here to work in partnership with tech and come up with the right strategic architecture at the outset.
Yes.
And not, and mentally, it's for those professionals to get out of the mindset of we come later, we're an infrastructure area. This is the business. If you start getting fines for this, it's going to blow up all equity value you have in your company. I mean, you've mentioned a couple of examples in yours. So I think, there's a real opportunity to get ahead of this, work your data science teams. There's no reason why you can't do this daily and actually drive insights that create alpha.
Exactly. Yes.
That's what has to be the focus. But I think the starting point comes with the individuals in the organization to start thinking as commercial business centers to really drive the innovation forward, as opposed to waiting for someone to notice that there's an opportunity here. Just my take, but I was on panels 5 years ago talking about this, and it's exactly the same with cyber.
No, absolutely. I think I would want to add a point here. Typically, when it comes to fintech, especially in the region, there's a little bit of in the crypto space. I think that there is some concerns, and the risk-based approach is quite robust. For other fintechs, it's a bit more relaxed, I would say. And it is potentially, when there will be a blow up, that's when sort of the regulators will probably start looking at it a bit more.
Here's the thing. I'm sorry, you got me passionate about something now. We don't have to wait for the regulator to come up with the solution. I think they can be part of the solution. Again, if I look at the Nordics on Bank ID, that was the banks building the core infrastructure. That solution adds 5% to the GDP each year of Sweden. There is an exciting opportunity for me if I look at the Middle East, which I live there, I'm passionate about it. To get this right, this could transform the Middle East into the power, into a real powerhouse of being able to solve some of these complex challenges very, very easily. The technology actually is freely available today. It's not going to be hard. I'd love to see that. Jehanzeb, you should build, I think, with your company.
Just to jump in there, Jehanzeb, I think back to James's point. I think given the geographic location that we cover, again, I mean, it's probably the most risky, and that kind of makes it much more difficult for regulators also from a report AML and compliance perspective. Hence, also it becomes more difficult for fintechs to get regulated by the regulator, because the regulator is very much concerned about what are their AML and compliance, that's internal procedures. So that's where we ourselves do a lot of work and try and get technology firms that can actually enable the regulator to detect or to be able to work with these fintechs, and also connect the technology providers with the fintech companies as well, to be able to develop a product for them which will help, which will satisfy the regulators' requirements. But again, as Jehanzeb and anyone that has worked in the region, it is one of the biggest challenges that we face, given the geography that we cover.
Thank you, Mohammed. I think we are running a little late, so we will probably extend the webinar for another 15 minutes. So for all the attendees, please do continue. We'll start the Q&A shortly. I think instead of going through all 4 themes, maybe we can start with or stop with the final issue, which is around the PO box and cohabitation issue. And Dr. Ryan, this is you are an asset manager. You have been a regulator. Obviously you don't live in a PO box. That's a small place to live. And when you receive mail or anything like that, how do you verify a PO box address or a residential address, right? And how does for example, if the lease is in your name or the ownership is in your name, how does your wife go ahead and open a crypto account that Jesse's Chainalysis will monitor?
Well, Jehanzeb, I think this is where we get to the thin line between technology and human intervention. Technology should be a facilitator, but should not replace the human presence and the human intervention with regards to these subjects. KYC and the elements of KYC are not, for me, quantitative elements. They're more subjective elements, qualitative, and this requires a human being going through them. And this is where time comes as a negative element into all of this. So let's set aside PO Box a little bit on the side. We've had a case. We've had a client providing everything perfect in his KYC, electricity bill, etc., etc., etc. And then it turns out that the utility bill, and it was discovered by a very young person in our team, just tech savvy, knows about Photoshop, that this electricity bill has been tampered with. The actual date has been changed because the requirement is at least 3 months. It should be not older than 3 months. The date was tampered with. It is the client's residential address. It is true. Simply the client didn't have the time to get a utility bill that satisfies it. So it was discovered that the utility bill that he provided was longer than 3 months. So it was a human being who discovered it. So where does technology versus human intervention intervene? I didn't see it. The senior persons in the team didn't see it. The compliance team didn't see it. It was a very junior person who saw it, okay? Right. We will have accidents. We should accept that. And this is why the risk-based approach is the way forward, okay? We will not be able to check absolutely everything, make sure everything is tip-top. We should really accept that there will be cracks. Things will slip through the cracks. We should accept that accidents will happen. And this is where the regulator also has to be pragmatic. Again, this is a subject very dear to my heart. And fundamentally, when I was on the other side of the fence as a regulator, in my opinion, a regulator should not be proactive. When a regulator is proactive, the industry stops working. A regulator should be reactive. The industry should evolve. The industry should try to self-adjust and try to do the right thing. And I align with you, James. The industry should be ahead of the curve, ahead of the regulator, and the regulator intervenes as a standard setter to set the standards according to how the industry has developed. So we should do it this way with PO Box. We should do it that way with utility bills. I don't believe in this. It should be really more granular than that. Than just if you have a PO Box, that's it. You're bad. Okay.
Right.
It's really a case-by-case basis.
Thank you, Dr. Ryan. I would want to add a comment here, right? So we have seen and some of the challenges and how the regulators have viewed this, particularly the cohabitation challenge, right? In the Middle East, you know, three friends living in an apartment who are all doing reasonably well, but they share an accommodation, and they are millennials, and you know, they want to open an account with Revolt, and then one account with BitOasis, another account with Binance or something like that. What we have seen is that you know, there is requirements to identify who has the lease under whose name, you know, what lease is under whose name, and what's your connection with that person. So so we have seen cohabitation letters signed by the applicant and the person who has a lease in their name, and the ID of the person who has the lease, provided at least to have some evidential documentation there that connects the parties. Now, again, going back to the same point about KYC, you know, when you go to a bank and take your passport, and the bank sort of looks at your passport, and you take the utility bill, it looks at the utility bill, and they say, okay, fine, you know, I'm happy you are the person in the passport picture. Actually, it's worse, if you ask me, than the digital solution, because a computer can identify a fake much better than a human being looking at a fake passport. So that's one. And two, again, the address, how do you verify the address? I have never opened a bank account where the banker has come to my house and verified that I live in that particular place, right? So there's evidential. So the view there is that a comparable approach has to be taken, and probably a more advanced approach, to your point, Dr. Ryan, you know, it needs to be taken by the regulators. But it is again to be seen, at least in the Middle East. You know, the market is evolving. A lot of fintechs are coming in. The focus right now is on building business right now and dealing with problems later. As Stuart, you said earlier, and James as well, that the time to build infrastructure is at the start, not after the fact, right? Because that's when you're really trying to chase your tail. So a lot of the challenges are going to come. We'll see some really awesome stories. We'll see some really not so good stories. But I think that's where the right mindset comes in, and addressing the challenges. And I don't know any regulator, and this is to the benefit of the regulators in the region or across the globe, that will be comfortable in guiding an applicant or their regulated entity on what to do. You know, that is just not possible for a regulator to provide. You know, they can share their thoughts, but the moment a regulator says that you should do it this way, if it doesn't work out, you can always go back to the regulator saying, oh, by the way, you told me that I should do it this way, this is not working. Or you will, you know, the firms will tell other firms that that's what the regulator has told us, that we should do that. And that has inherent problems in it. The regulatory sort of issues are kind of complex as well, but there's a fine balance that needs to be attained in that respect, right? So an open discussion. We have seen regulators who are a little bit too conservative in terms of not sharing their views, you know, not providing advice or telling people what to do, but sharing their views on how they see things. I think particularly with the fintechs or the new companies, that will definitely be the case. And it will also be the case with some of the older, larger institutions, because they're struggling. You know, the transition is happening from a more manual to a more digital world. And that's why you see, you know, the account opening process, I would say, in the Middle East is for lack of a better phrase, horrendous. It takes forever to open an account, whatever the reason may be, right? And that is, to James' point, adding a significant down sort of turn to the GDP growth, I guess. You know, the longer it takes, if you miss a month of business because you can't open an account, and if you're going to do $1 million of business, you can just do the math across 1 million businesses not being able to do business for a month, and what that impact, how that impacts the GDP. So with that, I think we have hopefully discussed the themes that we identified. We have had some questions, so thank you for the attendees to share those questions. What I would like to now take an opportunity to do is to introduce azakaw, and as they say, that a picture speaks 1,000 words. And in our case, a video speaks 1,000 pictures. So here's an introductory video of azakaw. Wonderful, thank you. That was our sales pitch, so I have to apologize for that. But I think now we can go on to the questions that the attendees have asked, and there's some really good questions. First question was, is this a recorded session? I don't think we have recorded it, but we will have another session for you, so hopefully you can attend that. I will start with a couple of questions here. One specifically names a regulator. I would remove the name of the regulator, but I would say the question is asking, a lot of the GCC regulators still require certified ID documents for non-face-to-face contact. How are these new technologies being received by them, and how they're open to how open they are to innovation? So Dr. Ryan, you are obviously regulated by one of the regulators in the region. What do you think?
Well, certified IDs, which goes to my point about the utility bill that got falsified. So you get the certified ID and you get the name of the lawyer with his number. You have to call the lawyer, verify he certified it. And so it's not a very practical approach. Face-to-face or video remains really the best way of verifying someone's ID. I think a certified ID would give a false sense of comfort, saying, yeah, it's certified, it's fine, let's file it. So this is what people tend to do. I'm not with that. I'd rather have a face-to-face or a video or liveliness test of some sort rather than a certified ID.
James, what do you think?
Jehanzeb.
Yeah, I'm seeing here kind of uncomfortable, like the idea of relying on a wet signature, you know, like it's not 1999 anymore. So look, I totally understand. I'm trying not to be flippant, but I totally get, you know, rigidity in emerging markets. I've lived it myself. But there's absolutely no way, as we scale, or as I scaled my last company or scaling Bloom, that I'd rely on a wet signature. If you're doing that in your process, something is fundamentally broken, and you are going to be the bottleneck for growth. And I want to just touch on one other issue. We keep talking about the regulator having a hand in this, and supporting it with them with new ideas, and I've done that in my career. All of that is excellent, but this also fundamentally becomes a question for government and politicians, which is, how do we want to power our economy? How do we want to lead for digital growth? And I think if you get the banks in the room with the right fintech enablers, or with the right capital, right? Fintech's about capital. It's nothing particularly special. With the regulators, I think you could really make a sizable difference to a market and unlock cross-border payments, unlock cross-border business, unlock national business, remove the reliance on oligopolies that exist in the world today, Visa, MasterCard, and others. So yeah, that's kind of my reaction, which is horror, which is we're checking manually utility bills in markets today, but actually I'm so excited about the opportunity to get that right in the Middle East, because it could drive enormous economic upside. Fantastic. That was a long answer. Apologies, Jehanzeb.
No, thank you, Mohammed. You were going to say something. I'm sure this is close to your heart as well.
Yeah, it is quite. In fact, I mean, given that my core role is to license fintech companies, it becomes a nightmare. It becomes a nightmare to get a company which wants to do it and tell them you have to come in person just to certify your passport copy or digital ID or your ID documents. And had it not been COVID, we would still have been doing it. I mean, thanks to COVID, now we've kind of pushed them to do it on a Teams or Zoom call, and that's why it's happening. Otherwise, it wouldn't have happened. I think really, I mean, we need to move quickly. I mean, at one side, we have businesses that are coming and transforming the way things are done, but we still, as governments or regulators, want to stick with our traditional way of doing, be it KYC or doing business, and that's really affecting businesses, Jehanzeb. And this goes back to the issue of companies opening up bank accounts, all the way to setting up a company. We have to adopt technology ourselves as well as regulators and financial institutions to be able to cope up and for the economy to grow.
Thank you, Mohammed. I think I will add a couple of points here, which is, in terms of, and I will name names here, the DFSA and the FSRA and the CBB and even SAMA and CMA, there is definitely good progress on this side. We have seen a good, practical, reasonable approach on this. As long as we can do a liveness test, validation of a person being a real person and matching their ID through facial recognition, biometric sort of matching and all that stuff, that definitely is acceptable and is working. Sometimes based on the type of business, particularly in the crypto space, because crypto is still, in some places it's mainstream, a lot of places it's not mainstream. There is a perception that crypto businesses are high risk, which, I would say to some degree are well-founded, to some degree they are not. Again, there's a risk-based view that needs to be taken. But if you take a slightly higher risk view, there are requirements to get 2 IDs, etc., from the people that are coming in. I think that regulators are also learning and getting comfortable. This is going to be a phased approach. And one thing that we have seen, everybody, and maybe this is just my view, and I will ask panelists to jump in here, everybody wants to be Mark Zuckerberg tomorrow, and Larry Page tomorrow, and they want to scale up, and add 1 million customers a day and so on and so forth. I don't think that's a lot of times when we meet people, that's the kind of impression that you get. But the opportunity is where the problems are, right? The whole point is to solve a problem to win an opportunity, and that's how you scale. So Middle East provides that. I think there's a massive opportunity. Middle East has never been able to scale because of the manual processes before, but now with technology, there's a massive opportunity to scale across jurisdictions, right? So So, and I think our regulators are also looking at it, and I have to give credit to a lot of the local regulators in moving the needle forward. But some of the more traditional institutions, some of the banks have to catch up with what the regulator wants to do, and what the financial institutions are doing, particularly, allowing the fintechs. So, Stuart, what do you think on that? Since you were the economic attaché here for a while, what are your thoughts?
Well, I mean, I agree with everything that's been said. I think that it's different than when I was the financial attaché. I mean, we talked about a decade being a long time. It was about a decade ago. It's hard to believe. I've gotten old since I was out there, Jehanzeb. But I think that it's a real opportunity, and I see I see action in the UAE and in Bahrain and in Saudi, and I think that action is certainly more important than studying a problem or talking about a problem or thinking about it. And I think it is a real opportunity, as everyone has alluded to. But it's still not over. We're still looking at utility bills, and I did sell a house in Abu Dhabi not long ago that required me to get on a plane and fly over to Abu Dhabi and sign something in person. So we do still have some of those issues, and I think even here in the U.S., regulators can want to be innovative, but sometimes that doesn't necessarily marry up with real action. I think it was 2018, 2019, we had a joint statement by regulators here about being innovative, and our financial institutions are definitely trying new things and pushing into that. But when you go and really sit down for a cup of tea or a cup of coffee and talk about trying radical things that might actually unlock a lot of efficiency or help direct the right information to law enforcement, if it's outside of the manuals, the BSA review manuals, the banks just really kind of clam up when it gets to that point. So I think where there's talk, and that's more talk, I'm skeptical. But when I see action and I see governments coming together and forming groups and forming consortiums and forming utilities that banks can plug into and actually use, I think that's exciting. And as an entrepreneur, anytime there's a big problem, there's a big opportunity. And I think that the Middle East, from an efficiency play perspective, has to be one of the most interesting places to build a company to try to solve this, particularly given how critical the region is to international commerce.
And I think just one more thought, sorry to jump in. It doesn't have to be complicated, right? We don't have to start on crypto assets, because they're always going to be the thorny ones.
From my perspective, of course.
Okay, we can, we control that in some markets, But actually, just get bank onboarding rights, right? Just get something small rights that can be then used as a digital authentication identity mechanism, and that will immediately start unlocking, the economic opportunity I think we're talking about here. And I think there's two or three really simple places to start that would be innocuous, but would clearly show the upside potential. And you just treat this like any kind of technology project, really. But that was my additive thought there, which is, let's not start on the really big, difficult things. Let's just start on a couple of tiny proof points that work across market. And, I think Mohammad is very well placed to be able to lead those in the region.
I'd just like to add three things to the conversation. First is from a consumer perspective, right? What we see is there's such an appetite, right, for the innovation in payments, right? And I think that it's important to give recognition to the region and the fact that, like Stuart mentioned, the UAE, Bahrain, and certainly those two within the Gulf are kind of leading the charge in relation to that kind of adoption of fintech and encouragement, right, for that kind of innovation, right? There's been a recognition there. And I think that that's important because the global consumer appetite continues to grow. The banks are kind of on the back foot in relation to that recognition. And so they're at a point now where it's kind of a critical inflection point where they have to make that decision, right, to embrace change. And I think when we begin to see that, they're going to apply more to this space, and we've started to see that. And there's disruptors as well. There's these digital banks that are beginning to be launched, and with it comes a new set of problems, right? For the regulators, bearing that in mind, right? The familiarity is an important component. And so I have sympathy with the regulators. And what I mean is, there was a conversation point that was brought up in this dialogue wherein somebody mentioned the fact that the regulators might not be sharing what they think in relation to a specific problem set. They may be developing what they think at the moment, right? Because innovation has been moving in a fluid pace that we haven't seen before, right? So regulation is built to be flexible, right? And technology agnostic. That's what the regulators tell you. With that being said, I don't know if they could have envisioned some of what we're seeing in relation to payments, right? And some of the new innovations. So it is progressive on both sides, right? And I think that context is very important to these kinds of conversations.
Yeah, I agree with you. I think in the Middle East, one of the key things that we're seeing is that a critical piece, which is the banking sector, is definitely lagging behind the others, right? That there's definitely fantastic policy initiatives by the governments, support by the governments. But then, again, and this is, I'm sure Stuart probably wouldn't like that, some of the OFAC related pressures that are in the region that basically make banks clam up when it comes to SME businesses and all that stuff, and the related fines that are happening in the US, et cetera. So it's a very difficult mix for the banks. Nobody wants to, lose the job as the CEO of a bank by taking on more SME risk that can expose them to. So there's a fine, I think, line here that people need to, and yes, as a consumer, as a small business, or as a fintech starting to run something and not getting, as one of our clients would say, not getting enough love out of the banks towards their business is difficult. And creates challenges. But I think I have a question here, which is quite an interesting one, specifically aimed at Jesse, which is the origin and destination of virtual assets. I think the question is talking about, one of the regulators is asking for this particular firm to identify origin of and destination of virtual assets across the chain. And obviously, we know that whenever there are tumblers involved and other things that are in there, it's kind of hard to do that. And if you sort of run into the exchanges. So Jesse, what would you tell them in this respect, right? How to address the regulatory question about origin and destination?
So these are questions that potentially go in a number of different directions, right? It could tie into source of wealth, right? Which is one concern that we certainly see in relation to virtual assets. We talked about potential sanctions implications and these kinds of issues. There's a number that could have touch points in relation to crypto and the use of crypto. So setting the stage there. For Chainalysis, we identify entities, right? We identify entities and services. And these are the choke points that I mentioned, right? Because the entities, the services, are going to be collecting that PII, conducting the compliance, et cetera. But within this ecosystem, you also have wallets that can be self-hosted, right? Self-hosted and unhosted. FATF has just addressed this, right? Meaning that individuals can create their own wallets, facilitate additional transactions. And so that creates a potential gray area in some instances that the regulators have been attempting to address. But I bring this in as context because what I say is from a Chainalysis perspective, we don't know what we don't know. However, the good news is that our data grows every day organically because we make more of those attributions, identifying source and transactional flows as more transactions are processed, right? And hit the touch points that we've already developed and the intelligence we've already developed. We have API integration and clients are running all of their transactions through this in real time, as I mentioned. And so from there, the attributions grow organically. things become more powerful and continue in perpetuity, right, to grow in relation to that coverage and attribution and identification. So there are moving parts, suffice to say, right? What I expect to see is that when these kinds of entities in some jurisdictions cannot make those attributions and identify that successfully, that they may not be able to process those transactions. It is a concern that the industry certainly has, right? That it will have an impact on business operations, but some of the regulators are going in that direction, right? And that potentially requires additional collection of information, right? Possibly not even transfer or submission to the regulator, right? But it's a collection requirement that is coming into play in the UAE and in other jurisdictions as well. You see that. So I don't know if that response suffices, but that's really kind of positionally where we're at.
Thank you, Jesse. I appreciate that. I think one last question before we close. It's in relation to common KYC requirements across different jurisdictions, right? This is probably a question that Dr. Ryan and Mohammad should answer. You know, in your days at the local regulator, and probably Stuart as well, right? It would be very nice, and this goes back to my scale point before, very nice to have a common requirement across the GCC for KYC, sort of a GCC utility per se, if it's at all possible, right? Or at least a countrywide utility. So what are your thoughts in terms of, although the rules are based on FATF requirements across all the jurisdictions, but there are some peculiar sort of differences, and at least the treatment by the regulator. So Dr. Awan, what do you think? What's the way forward, again, to Jesse's point or James' point about unlocking economic growth by making it easier and business to be frictionless?
Well, standard setting with regards to KYC is already there. We know we need an identity, we need a proof of address, etc. This is already set. Now, where it gets a little bit complicated is when on the start of the webinar, where you're saying the commercial license, for example. Okay, so the client providing a commercial license, he should not need to provide a commercial license. I should be able to have a reference, go on the website of the registrar, and pull myself the commercial license for that client. No need for him to provide it. So this can be done using technology. So where technology can pull that information rather than have it pushed by the client. So I'd rather go into the pull rather than push approach with clients, but this requires that the regulators, they set certain standards with regards to having this information available on the website, readily available, not in a completely open way, but based on specific references. For example, utility bills, no need for the client to provide the utility bill. We should be able to go to the website of ADDC or the Dubai Electricity Authority, and just with a reference, download that utility bill. No need for me to check whether the date has been tampered with or not. So this can accelerate substantially the KYC elements.
Thank you, Dr. Ryan. Mohammad?
Yeah, just to add on to that, Jehanzeb, I think it would be an ideal world. I mean, if across GC we have similar requirements. I mean, the whole market is so small. I mean, we've got what 200 to 250 million, including Egypt. But I mean, there's so much variance, and of course, market from market differs as well. UAE is a bit too advanced, and then let's compare to Saudis coming up, but still, I mean, you can't compare them in terms of requirements, also policies and procedures that are followed. Also, even within domestically or locally, not all regulatory bodies or government bodies probably follow the same let's say procedures, or the level of scrutiny is as much as it should be, which makes it very challenging to make it centralized. And also going back to Ryan's point of making data available, I think one of the biggest challenges that we have when it comes to especially when it comes to client onboarding. Most of our data is not public. I mean, there's very less data available publicly. Wherein, I mean, I sit with companies and especially, I mean, of course, yourself as well. I mean, if you were to find details about any company, you can't just find it in any of the public registries. And we've got so many different zones across the GCC who have so many different companies, but the data is very limited. I think that's. It would be ideal if we have let's say a bit more centralized view on requirements and procedures, but I think with technology and with globalization, it would evolve. Yeah.
Thank you, Mohammed. Thank you very much. I think we are over time now, so I would like to thank all the panelists. Thank you so much for your contribution. I think I found the discussion very, very useful, and your contributions have been fantastic. So thank you again. Thank you to all the attendees as well. Fantastic. We look forward to hearing from you further. This is the first of a series of webinars that we'll be doing as part of our global launch, and then we are looking to start an accelerator program for pre-seed fintechs in the space in the MENA region. So, so if there are any fintechs that are participating in as attendees, you have an open opportunity to apply for the accelerator program, through which you will get a free annual subscription to azakaw for a year. So we will select a couple, two participants there. And we will also share the same program on our social media channels. So again, thank you to the panelists. Thank you to all of you. Really appreciate the time. Good luck, stay safe, and we'll see you soon.